right, so welcome to Chapter 15. And Chapter 15 is about different types of business entities. And you might be wondering, okay, well, this is an individual tax class. Why are we talking about different types of business entities? Well, the reason is that individuals, right, derive taxable income sometimes from investments in business entities or working for business entities. And depending on what type of an entity we're dealing with, the taxation of that income can be very different. So let's talk about some different entities. All right, so this is a kind of a chart directly from your textbook. All right. But what it does is it gives you an overview of some non-tax characteristics of entities. And these are important to us because it kind of gets to the motivation as to why you would form a different type of entity. All right. And so you may be familiar with these entities already, but maybe not. So we'll briefly go over them. So corporation. All right. Now, it's important to know that when we talk about a corporation just in general, all right, we're talking about a publicly held, or maybe not necessarily a publicly held, but certainly a C corporation, okay? And so what do we know about the great things about a C corporation? Well, so you can do a public offering, right? We can sell shares of stock, and then you could go public with those shares of stock. The legal arrangement among the owners, once the articles of incorporation are set, it's not particularly flexible. All right. Now, responsibility for business liabilities. All right. If I own shares of Walmart and Walmart gets sued because someone slips and falls in their store, that does not impact me directly from a liability standpoint. It may reduce the price of my stock, but the entity is responsible for its business liabilities, right? And obviously you must formally organize with the state. Now, we could contrast that and compare it to an LLC. An LLC is a limited liability corporation, okay? You still have to formally organize with the state, but you have a very flexible legal arrangement. You cannot have a publicly held LLC. And one of the cool things about an LLC is that you still have the corporate veil. So the entity is still responsible for the liabilities related to business operations. All right. So, for example, an LLC is a great example of an entity that could be set up pretty quickly and easily for a small business, and it gets your personal assets out of the fray from a liability perspective if you were to get sued. All right, and then we have general partnership and limited partnership, and we need to talk about those kind of in the context of each other, because the difference between those things is that in a general partnership, all of the partners are considered general partners. So all of the partners are responsible for management responsibilities, and all of the partners have what's called an active role in that business. In a limited partnership, you have at least one general partner who's responsible for the management and the overseeing the day-to-day business of that entity, and they are considered an active participant in that partnership, whereas anyone who is a limited partner is considered a passive participant in that business. All right, and we'll get to why that matters in a minute. And then you have a sole proprietorship. A sole proprietorship, you don't have to formally organize with the state. There's no legal arrangement among owners. Obviously, it's not suitable for a public offering. And here's the kicker. All of the business liabilities are responsible, are the liability of that person who sets up the sole proprietorship. So for example, say I decide I'm going to start a business of mowing people's lawns, okay? And I start mowing lawns and I decide, you know what, it's super easy to be a sole proprietorship because all I have to do is grab my lawnmower and put it on my utility trailer and see if anybody wants me to mow their lawn. And I start driving around mowing lawns. I recognize that income on my tax return. No big whoop, right? This is fantastic. Well, what happens if my business grows, right? And so now I have me and someone that works with me, for me, in my sole proprietorship. And that person who is working for me is mowing lawns, and they run over their foot because my lawnmower malfunctions, all right? And that person sues me. Well, now that person can sue me related to the business, but also all of my personal assets, all right? If I were organized as an LLC, they would not most likely be able to get my personal assets, so my house, my car, right? Only business-related assets would be in the fray from a legal perspective, okay? So it's important to know the non-tax characteristics of these businesses because that gets to the motivation as to why you would set up one type of entity versus another. All right, so now this is a tax class, so let's talk about tax stuff. All right, so now let's talk about how these things are classified from a tax perspective, okay? So for tax purposes, you have what's called check the box regulations, okay? So if you are an S corporation, for example, you can check the box and be taxed as either a C corporation or a partnership, all right? So let's talk about what that means. A C corporation is a taxable entity, okay? An S corporation doesn't have to be a taxable entity. An S corporation can be taxed like a C corp or a partnership, and we'll get to more of that in a bit. But the way they make that choice is what's called the check the box regulations, and that is literally on their tax return. There's a box that they check, okay? So when we say some business entities are tax-paying entities, what does that mean? What that means is they file their own tax return and have a tax liability specific to them, okay? So C corporations, right? We have individual tax rates and we have that progressive schedule. And then we know that C corporations have a tax rate right now of 21%. So they have a flat tax rate of 21%, okay? So a C corporation is a tax-paying entity, all right? So individuals, we're tax-paying entities. C corporations, estates, trusts, okay? These are all tax-paying entities, all right? And then we have this thing called a flow-through entity, all right? And so a flow-through entity is not a tax-paying entity. All right, now I want to be clear, they're not a tax-paying entity, but that doesn't mean they don't pay taxes. What that means is the tax liability flows down or flows through to the owners. All right. So if, as a class, we decided to set up a partnership, we were all going to go into the landscaping business and set up a partnership, and we were all going to be partners. Okay. That would be a flow-through entity. Now, that partnership would have to file an informational return every year, but that partnership would not have tax liability at the entity level. All right, so if I had a 1/20th share of that partnership, 1/20th of that partnership's income would flow through to my tax return. Okay, so that is a flow through entity. Okay, so some other things that we need to talk about. Corporations are C corporations unless they make a valid S election. All right, so an S corporation is a special type of corporation. And an S corporation, you get the choice of being taxed as a corporation, a taxable entity, or being taxed like a partnership, a flow-through entity. All right, but there are some limitations as to who can be an S corporation. All right, so S corporations can only have 100 shareholders. Now, there are all kinds of somewhat crazy rules about how those shareholders are counted. We're not going to worry about that right now. But S corporations can only have 100 shareholders. So that tells you that that is not a situation where that stock will be able to be sold publicly, right? Because you could have more than 100 shareholders, all right? When we talk about unincorporated entities, what are we talking about? We're talking about sole proprietorships. And partnerships. All right? Okay. Now, entity losses. All right? Let's talk about entity losses. All right? All right, so this is a great summation slide for flow-through entities, all right? So again, flow-through income is taxed at the individual marginal rate, all right? So that income just gets dumped in the same bucket as your other income, essentially, and it increases your taxable income, so it changes what tax bracket you're in, potentially, all right? Passive investors. Remember we talked about those limited partners, right? All right. They're potentially subject to an additional 3.8% net investment income tax. We'll talk more about that later. All right. And then potentially there's also self-employment tax and Medicare tax, all right? And we will talk about those things a little bit too, okay? So right now, it's important to know the difference between a taxable entity and a flow-through entity and what that means generally from a taxation and income perspective. All right, so one of the things that is still relatively new, and here shortly, I guess I'm not going to be able to say it's relatively new anymore, is this qualified business income deduction, okay? Now, this is a lot of times called the QBI deduction. This is new as of 2017, so that's why I say I'm not going to be able to say it's new for too many more years. So this came in from the Tax Cuts and Jobs Act, all right? And why we have this is with the Tax Cuts and Jobs Act, we cut the corporate tax rate from the top rate of 35% down to 21%. And so what the concern was is that would then disadvantage the other business entity types. So if C corporations are only getting taxed at 21%, but you have all of these flow-through entities that flow through, the income flows through and then gets taxed at marginal rates, which are in several brackets are above 21%, right? Then you're now disadvantaging businesses that are not organized as C corporations. And so they created this qualified business income deduction, okay? And it's potentially available to flow through entity owners. And the reason there's potentially in there is because there are some income phase outs that we are not concerned about at this particular moment, okay? It is a from AGI deduction, but it's not an itemized deduction. That phrase may not mean much to you now, but it will later on in this course, all right? And it is basically the nuts and bolts right now. It's a 20% deduction for what is considered your qualified business income, okay? So in our partnership example where we had 25% of the loss coming to us, if that were $100,000 of income and we owned 25%, we would have $25,000 of qualified business income, generally speaking. And then we would take 20% of that, and that would be an additional deduction against our taxable income. Again, we will talk more about that later, but it's important to know that this QBI deduction exists, and generally speaking, what it is. All right, so we already kind of talked about, in general, corporations are taxed at 21% now. Again, that is a result of the Tax Cuts and Jobs Act, so that is since 2017, okay? And then we've already talked about the fact that there's double taxation, so there's a second level of tax, right, when there are dividends involved. And from an individual perspective, all right, dividends do get preferential tax treatment. So either 0, 15, or 20%, depending on your income level. And we will go through the tax rate schedules and show you how to calculate those for different individuals later on. And then potentially, depending on your income level, you may also have this 3.8% net investment income tax, all right? And we'll get to all that. Right now, we're just introducing all of these topics generally speaking, okay? All right, so kind of the differences between owners of entities, all right? If you are organized as a sole proprietorship and you're the owner of that proprietorship, there's no direct compensation. Whatever money is earned by that sole proprietorship, it all gets attributed to you. And so there's not a salary per se. For S corporations and C corporations, employees can earn salaries, all right? And then those salaries are subject to employer and employee portions of FICA taxes, so Social Security and Medicare. Wages are deductible by the entity, all right? And S corporations and C corporations don't get this QBI deduction, okay? Now, what if you're taxed as a partnership? Now, this is if they're taxed as corporations, okay? Remember, an S corporation can be taxed as a partnership, all right? If you're taxed as a partnership, then you can have what are called guaranteed payments, all right? All of the income that comes from that partnership that flows through to you is self-employment income. We'll talk about why that's important later. The guaranteed payments are deductible by the entity, and guaranteed payments are not eligible for the QBI deduction, okay? One of the most important differences between C corporations and flow-through entities are the way losses are treated, okay? So the cool thing about flow-through entities is that losses are generally able to offset the owner's personal income. Okay, now these are subject to certain restrictions. So, and the restrictions are listed down below. So, basis, at risk, passive activity, and excess business loss limits are all ways that flow through entities are limited in the amount of losses they are able to net against the personal income of the owners. All right, the ones that we are most concerned about in this class, because they're the most frequently encountered, are the basis limits and passive activity rules. All right, so let's talk a little bit about them. All right, so first, let's deal with basis. All right, basis is essentially the skin you have in the game. All right, how much of that flow-through entity are you responsible for, and do you have invested? Okay, so your basis increases with income. It decreases with losses, but it also decreases with distributions, dividends, okay? So if, for example, you create an LLC in 2019, okay, and say you contribute $10,000, your basis at the beginning of the year, when you make that contribution, is $10,000. Okay. Now, if over the course of 2019 you have income, and that income is, say, $5,000, then your end of year basis is $15,000. Okay. That basis at the end of 2019 is the 2020 beginning basis. All right. Now, if you were to have a $10,000 loss in 2020, then your basis at the end of 2020, and I should have done this a little bit neater, so I apologize for that. So your end basis at the end of 2020 would be $5,000, okay? I'm going to switch colors here. Hopefully that'll help from a neatness perspective, and we'll scroll down. And so if your end basis 2020 is $5,000, then your beginning basis for 2021 is $5,000. Now, let's say 2021 is a bad year and you have a loss of $30,000. Your end of year basis is zero, okay? Because your basis can never go below zero, all right? So your end of year basis is zero, and the amount of the loss that would flow through, is $5,000, okay? So the amount of loss that you'd be able to use in the current year to offset your personal income would only be $5,000. You would get to carry the rest of that excess loss forward, okay? So that's basis. All right. Now, let's talk about passive activity as well. All right. So passive activity is different than basis. So hold on, let me switch color. All right. All right, so when you are an active member of a flow-through entity, you are considered to be earning active income. When you earn salary at a job you work for an employer, that is also active income. Passive income is a result of a passive activity, okay? Many times, passive income results from ownership in a limited partnership or being a limited partner in an entity. So passive losses can only be deducted to the extent that there is passive income. Okay? Now, unused passive losses can be carried forward and used in future years when there is passive income. Okay, so what happens many times is people will be investors in a variety of businesses that are housed in a variety of entities. And if you have a passive loss in one entity, then that can be netted against passive income in another entity. Okay, so that is kind of the nuts and bolts of losses for flow-through entities. We will talk more about the excess business loss limits in class together. All right, what about converting to other entity types? Okay. So you can move back and forth, all right, between entity types. However, there are sometimes tax consequences to those decisions, all right? All right. So let's do a quick example to make sure we understand this whole loss thing, all right? So we've got Nicole, and she's going to organize this business as a C corporation, okay? And in spite of her best efforts as CEO, this C corporation has a loss of $50,000 in the first year of its operation, okay? And we're going to set Nicole's marginal rate at 35% and assume she has ordinary taxable income of $200,000 because she's married, filing jointly, and her husband has a salary, okay? So how much tax will her C corporation pay in year one? And how much tax will Nicole and her husband pay on that $200,000 of other taxable income if this business is organized as a C corporation. All right, so I'm going to pause for just a minute. Okay. All right, now let's set this up. So we've got the C corporation, and we've got Nicole and spouse. Okay. All right, so what do we know about losses for C corporations? Well, losses for C corporations are contained within that C corporation, right? They're stranded in that C corporation. So this C corporation has a $50,000 loss, all right? Does the C corporation have to file a tax return? Yes, that C corporation has to file a tax return. Remember from Chapter 2, C corporations always have to file a tax return every year, even if they lose a big old pile of money, okay? But how much tax liability does this C corporation have? Well, that C corporation has 0 tax liability, all right? Now, what is our taxable income for Nicole and spouse? Well, they have $200,000 of taxable income. And if their marginal tax rate is 35%, and we just apply that to the 200,000, we find that their tax liability, is $70,000, okay? So if Nicole organizes as a C corporation, the C corporation generates this loss. Now, they're going to get to carry that loss forward, right? But it doesn't have any direct impact on Nicole's taxable income or her tax liability in that year, okay? Now, if we move forward to the next slide, now it's going to say, suppose that we organize as an S corporation, and we're going to assume that S corporation is taxed like a partnership, all right? And Nicole's basis is $100,000, all right? And so now the question is, if they still lose, so if this S corporation still has a $50,000 loss, all right, and Nicole and spouse have $200,000 taxable from salary. Now, how much tax will this corporation pay in year 1, and how much tax will Nicole and her husband pay on that $200,000 of income? Well, remember now that we've said this S corporation is flow-through. Okay? So the S corporation pays 0 tax at the entity level, but this $50,000 now can be directly deducted from Nicole and spouse. All right? And so now they have $150,000 of taxable income. And if we assume they still have a 35% tax rate, now their tax liability is considerably lower. okay? So sometimes, from a strategy perspective, it makes sense to have a business organized as a flow-through entity for its first several years, because then you get the benefit of those losses against your personal income tax, okay? All right, and you can see some different calculations here on this last slide, all right? That is it from a lecture perspective for Chapter 15. Thanks, guys.